It is the 18th of October 2021. My name is David Hickson, and in today's market update I'm going to be speaking about the S&P 500 and also the FTSE-100 because some interesting things have been happening in stock markets around the world. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So we're going to start off with the S&P 500, and in the interests of brevity, I'm not going to go through absolutely everything about this analysis. If you haven't watched previous market updates in this series, then I would encourage you to do so that you have an understanding of the bigger picture. Of course, we are looking at a major cycle trough forming in March of 2020. In the case of this analysis, it has been phased as the 54-month cycle trough. Recently, as you might know, we have been discussing the position of the 18-month cycle trough, and this is an analysis that I've been referring to for some time as my preferred analysis. I'm not sure if it is still my preferred analysis, but it is certainly a viable analysis that I have been keeping an eye on, and you can see that it has positioned the 18-month cycle trough over here in about the middle of July. Now, we've had a very interesting thing happen in the S&P 500 and in the US markets, which is that we have had this sequence of cycle troughs, or at least price troughs, forming, and there was another one over there. So we had a sequence of troughs forming in price, and they are fairly difficult to differentiate in terms of there isn't a really strong cycle trough that has formed in that period of time from May all the way through to September. So for those months we had some price troughs forming, and a cycle analyst of course needs to identify what cycle trough is forming at a particular time, and so that's been a challenging thing for any cycle analyst. We have seen a deeper trough forming over here, and as mentioned in previous market update videos, that trough formed at about the time that the 18-month cycle trough was expected. And so there is a possibility that the 18-month cycle trough has just formed now recently in this market. And we'll take a look at another analysis in a moment that considers that possibility. But as you will know, if you have been watching these market update videos for some time, I have been discussing the fact that it is not necessary as an analyst, if you're going to be making trading decisions, it's not always necessary to have absolute certainty in terms of the magnitude of the trough that is forming, as long as the trough that is forming in the markets is of a magnitude that will enable you to make sensible trading decisions according to the time frame that you're trading over. Of course, if you absolutely have to identify an 18-month cycle trough, then that would have been challenging. But recently, according to this analysis, and according to other analyses that I have been discussing in these market update videos, we were expecting a trough of at least 80-day magnitude to form in this market. And it would seem that that 80-day cycle trough has now formed. So let's take a look at another analysis that I've been speaking about in these market update videos. This is what I call the default analysis. It is the analysis that Sentient Trader performs without me influencing the analysis in any way. And so I call that the default analysis. And as I've mentioned in previous market update videos, very often Sentient Trader produces a better analysis than I do. Despite my many years of experience, I will influence an analysis, and then it turns out that the default analysis that Sentient Trader has been performing all along turns out to be the correct one. I'm not saying that is definitely the case here, but the important thing, in my opinion, is to keep an eye on the default analysis that Sentient Trader is performing, because sometimes it turns out to be correct. Now, the big difference with this analysis, if you ignore the extra magnitude of this trough in March of 2020, you can see that has faced the 9-year cycle trough there. That's a separate debate that we could have at another time. But the difference in terms of this analysis is the position of the 18-month cycle trough, which you can see is in this analysis presented as a nest of lows looming ahead of us. And that nest of lows is centered in early or perhaps about middle of December. And so the big difference here is that this analysis tells us to expect an 18-month cycle trough lying ahead of us. Is that correct? Well, that's really the point that I'm making here. We don't know. This could be the correct analysis, or the other analysis could be the correct analysis, or a third analysis that I'm going to show you in a moment might in fact be the correct analysis. I know that some people find that very frustrating, but the important thing, as I am going to demonstrate in a moment, is that even though there is some uncertainty, there are ways that we can still approach the markets and trade them with some confidence, even though we have some uncertainty in terms of the analysis. So we're going to get there in a moment. The important thing here is that this trough that has now been found in the analysis is a trough of 80-day magnitude, which is of course exactly the same magnitude as in the other analysis that we looked at a moment ago. Now, what about the possibility that the 18-month cycle trough has formed over here? That is possible. I've discussed it in previous market updates, but in my opinion, it is the least likely analysis. I'm going to show it to you very briefly and discuss another reason or two why I think it is the least likely analysis. Here it is, and as you can see, I have influenced this analysis. That's what those pin symbols represent. I've influenced the analysis to get Sentient Trader to present me with a nest of lows that is round about now. And so it is just possible that this trough that formed last week was, or not last week, in fact it was 2 weeks ago I believe, that was a trough of 18-month magnitude. But for reasons that I have presented in previous market update videos, this is my least preferred analysis, and I think the chances of this one turning out to be the correct one are fairly low. One of the big reasons is the fact that this 40-week cycle trough over here has been pinned to be at that position. That doesn't make a lot of sense to me, and if we zoom in again, I can show you another reason why I don't particularly like this analysis. Here are the fairly prominent price troughs that we have observed over the last few months, as you can see. And that trough is now a 20-week cycle trough in this analysis, 40-day over here, 80-day over here. That all looks quite good. And then we have this trough in the middle of September, and that has been phased as a 40-day cycle trough. You can see I have influenced that. But then we had a fairly clear and strong trough that has formed over here right at the beginning of October. I think that was the 1st of October. And price has since then moved upwards fairly strongly, which would mean that the prominent trough that we are expecting, which you can see the nest of lows is leaning over there, so it is possible. It means that that trough should really be positioned there. And that just doesn't really make sense because, as you can see, we then have very few days that have elapsed since the 40-day cycle, only 11 days. So that doesn't really make sense. And if we measure back to this 80-day cycle trough over here, it's 43 days. And we can keep measuring the distance to each one of these troughs. And you can see they just don't really make sense in terms of the nominal model that we are working with. And so in my opinion, this is a very unlikely analysis, but it is nevertheless one that I do continue to keep an eye on. So let's come back to the important point that I'm trying to make here, which is that even though we have some analysis uncertainty, we are able to make some fairly consistent and successful trading decisions. And the reason for that is because when we are anticipating a particular cycle trough, and in this case it is the 80-day cycle trough that I've been speaking about over the past few weeks, then the different analyses will often still be expecting a trough at about the same time, but the magnitude of that trough will be different. So in the first two analyses that I showed you today, the magnitude of that trough was 80 days. And in the third, least likely analysis, it was a much bigger trough of 18-month magnitude. So the important thing in terms of making trading decisions is that as we are expecting an 80-day cycle trough to form, that is what we are focusing on, is identifying the position of that trough. So now I'm going to zoom in here on this analysis. Actually, before I zoom in, let's just go back and let's display what the implications of this analysis are by means of displaying the composite model line. I've presented the composite model line in many of these market update videos, and as you probably know by now, it is simply a composite of all the information that is contained in the analysis, including the wavelengths and amplitudes of each one of the cycles found in the analysis. That information is recomposed into a line that is effectively telling us in the past what price action would have been if the only thing influencing this price action had been the cycles that have been found in the analysis. That information is then projected forwards into the future on the basis that cycles beat with some regularity. And so it makes the assumption that the wavelengths will continue to beat with the same wavelength and the amplitudes will continue to be the same, which of course we know will not be true because of the principle of variation. Wavelengths and amplitudes are constantly varying. But nevertheless, it gives us an idea of what the implications of the analysis are. And in this particular case, we can see that there has been a discrepancy recently between price and the composite model line, indicating that this position of the 18-month cycle trough might not be correct. It doesn't absolutely cancel this analysis, it doesn't absolutely deny it, but it does certainly raise some question marks. But the important thing is that the composite model line shows us what we can expect to happen according to this analysis. And as you can see, we are expecting price to pretty much move upwards because the 18-month cycle trough lies behind us. And so that's the first important thing to bear in mind. Let's take a look at our default analysis and compare the composite model line on that analysis. Here it is. Now the composite model line on this analysis is showing a fairly different picture. In particular, of course, it is representing the fact that price is expected to move down into this 18-month cycle trough, which still lies ahead of us. But now that's not a very strong move down. So why is the composite model line presenting such a feeble move down into the 18-month cycle trough? Well, I think there's an interesting discussion to be had here about the way in which the composite model line is constructed. As I've mentioned, the composite model line is working with the information that is contained in the charts. And so why is there so little move down expected because of this analysis? Simply because the software, when building the composite model line, has not found much evidence of the 18-month cycle influencing price to move down into its trough. And so therefore, when it recomposes that information to produce the composite model line, there isn't much of a move down. And let me turn off that composite model line and explain to you exactly what has happened here. The software has measured the 18-month cycle, and we can actually see the results of that measurement by simply displaying what is called the cycle line. This line represents the 18-month cycle as measured in this particular analysis. And of course, here is the trough of the 18-month cycle. Not a surprise, because there is the trough marker, the diamond that represents the trough of that 18-month cycle. So now you will notice that at this point where we have the trough of the 18-month cycle, we have an amplitude that can be measured on the Y scale, whereas the trough that is expected in the future, in the middle of December, has a much lower amplitude. Can you see it is a much smaller range on the y-axis, so it has a much lower amplitude, indicating that the 18-month cycle, as found in this particular analysis, I must point out, is reducing its amplitude. Now, why is that? Well, it's really very simple. Here, the 18-month cycle is influencing price to rise, and indeed price did rise. But at around about this time, the 18-month cycle, being represented by a sine wave, must have started turning down, as indicated by the line over here. And so the reason why the software, when composing the information from all of the cycles, is not indicating much of a downward movement is simply because of the fact that when the 18-month cycle was moving down, ever since, where was this peak expected? Well, at around about the time of the 40-week cycle trough, so in early March. So since early March, the 18-month cycle has been influencing price to move down. And what has price done? It has moved up. So what does that mean? It doesn't mean that the 18-month cycle has disappeared. According to Hurst's basic principles, cycles do not disappear. What it does mean is that the influence of the 18-month cycle has been minimal in terms of the way that we can measure it in what it is doing to influence the price action. And so it is for that reason that our composite model line does not tell us to expect a big move down into this 18-month cycle trough, simply because the 18-month cycle does not seem to have been influencing price very much at all. Let's add another cycle into this, and you will see here is the 40-week cycle. Let me clear that pen, and you can see here the 40-week cycle has also provided very little influence in terms of price action. You can see it is actually pretty much flatlining. And so there is where the 40-week cycle should have turned down and started influencing price to the downside, but there has been no evidence of downward price movement, which is why the composite model line is not really telling us to expect much of a move down. So now let's get back to the central idea that despite the fact that we are not entirely sure about the magnitude of that trough that lies behind us, we can nevertheless make some sensible trading decisions. So let's go back to our other analysis and start there. And let's zoom in. Let's turn off that composite model line for now. Let's zoom in and consider what we are expecting to happen now. Because we have been expecting an 80-day cycle trough to form, and you will know that there was some difficulty in terms of identifying this 80-day cycle trough. We're going to take a look at a moment at the FTSE-100 and discuss this 80-day cycle trough, because that is something that's been really interesting to observe as it has formed in the markets. But because we were expecting an 80-day cycle trough, what we can do is look at the shape of what we are expecting to play out for the next 80-day cycle. And the shape, of course, is expected to be an M shape. We expect price to move up to a first peak, then come down into a trough, which will be the trough of the 40-day cycle, then come into a second peak, and then come down and finish the M shape. And that is the M shape that we are going to be trading. But now the M shape gets distorted because of the other cycles that are present and that are also influencing the price action. So how do we understand what kind of an M shape to expect? Well, one way of doing it is to simply look at the composite model line and display that composite model line to show us what we would expect on the basis of combining all of the cycles that have been found in the analysis. Now that doesn't look a lot like the M shape that I drew a moment ago, but in fact the reason for that is because it is very simply an M shape that has been distorted to the upside. And so following this 80-day cycle trough, that is our expectation for what price should do. In other words, we're going to witness a 20-week cycle trough at a much higher level. So we're looking at bullishness in this market. And how would we approach trading decisions on the basis of that expectation? Well, I would use an FLD. So in this case, because we're looking at an 80-day cycle, I would work with the 20-day FLD. And of course, I expect a sequence of interactions with this 20-day FLD. I spoke 2 weeks ago about this interaction over here, which potentially might have been at the time the first interaction between price and the 20-day FLD following a potential 80-day cycle trough. It turned out not to be an 80-day cycle trough in the S&P 500, and so the correct interaction was this one over here. It was a bit of a miserable interaction. As you can see, it happened over the weekend, and I spoke about this in last week's video, so I don't need to repeat it. But we did end up getting price slipping across that FLD and generating a target to the upside. I believe that the target for that price cross is at a level of about 45.30 over there, and price has not yet reached that target, which might be an indication that there isn't as much bullishness as we would hope, but it is not definitive evidence yet. The next thing that we expect is for price to come down and find support at the level of the 20-day FLD. And you can see in terms of the Composite Model Line, the cycle information seems to indicate that that might have already occurred over here, where price came down and did find support at the level of the 20-day FLD. That might turn out to have been a very early 20-day cycle trough, but in my opinion it was probably a 10-day cycle trough that formed over there, and we are now expecting the 20-day cycle trough to form. Then, of course, price will continue upwards to reach its first peak. It'll come down and form the 40-day cycle trough over here, come up and form its second peak, and then come down into the 20-week cycle trough. As we get nearer to this time over here, towards the end of November, we will have some more cycle information to work with to anticipate how much this move down is, how strong that move down is likely to be. So let's take a look at the other analysis and compare what our expectation is in that analysis. And here you can see the difference between these two analyses. We're looking at roughly the same period of time. Can you see the M shape that I drew earlier here? And this M shape represents the difference between these two analyses. If the 18-month cycle trough still lies ahead of us, we will still expect price to bounce out of the 80-day cycle trough and give us a move upwards. But the M shape is going to be distorted to the downside. I hope that that difference is clear. And let's take a look at our FLD, which again can be used to make our trading decisions on the basis of the targets that are generated and the sequence of interactions that we expect. The FLD is in the same place here. It is ever so slightly over to the left, but in fact our target is pretty much exactly the same. It is at a level of 45.30, and so price has not reached that first target. We are now expecting the 20-day cycle trough to form. As you can see, there's the nest of lows, and our expectation is the same. But it is not quite the same because of the fact that this is going to turn into a bearish M shape, whereas in the other analysis it will be a bullish bear shape. And according to this analysis, of course, the net move from the 80-day cycle trough up to the trough that is expected to form in mid-December is expected to be pretty much hardly any move upwards at all because of the bearish shape of the M shape that the 80-day cycle is going to form. So what we do is we track each and every day as new data comes in. We are tracking the way in which this M shape is forming. If it begins to turn bearish, then our favorite analysis might swing in this direction with the 18-month cycle trough behind us. If it remains a bullish M shape that is forming in the markets, then our favorite will turn to the 18-month cycle trough being behind us. But either way, we are able to carefully, day by day, track the formation of this particular cycle. Now let's hop across the oceans to the FTSE-100, and there are a few really interesting things to speak about here. One of the reasons why my preferred analysis for some time in the S&P 500 has had the 18-month cycle trough here in the middle of July is because the FTSE seemed to form an 18-month cycle trough at that point over there in the middle of July. It has, of course, formed another trough over here in I think that's about the third week of September, which is another potential candidate for the 18-month cycle trough. But if we do a little bit of bar measuring, you can see that at this position at 547 days since the trough in March of 2020, that is perfect timing for an 18-month cycle trough. But as I've mentioned a few times recently in these market updates, it is not just the wavelength of the cycle that we need to bear in mind. It is the way in which the shorter cycles fit together to form the complex puzzle of the different cycles that influence the financial markets. And so although that is a very good position for the 18-month cycle, and a novice analyst might want to position the 18-month cycle trough there without even questioning it, we need to look at the shorter cycles. And if this was a trough of the 18-month cycle, then we need to ask ourselves, where is that 40-week cycle? There was a nice prominent 40-week cycle trough, I should say. There was a nice prominent trough here at the end of October, which provides a good position for the 40-week cycle, in my opinion. But if we measure the number of bars from there up to this potential 18-month cycle trough, you can see there have been 325 bars, 53 days longer than the average 40-week cycle, and it gives us a very lopsided picture. It's just not nearly such a good analysis. And so this analysis is still my preferred analysis in the FTSE-100. I've done very little influencing of it. I have positioned the 20-week cycle trough over here, as you can see, because of the fact that there was a bit of a triangle formation over there, but that's a discussion for another time. But the important thing really is what has happened since that potential 18-month cycle trough formed over here in the middle of July. And here is the interesting difference between the S&P 500 and, in fact, the US markets and the European markets and the FTSE-100. The FTSE-100 has very clearly experienced an 80-day cycle trough over here on, what's that, the 20th of September. And we have a very beautiful M shape here for the 80-day cycle, and I can draw that in here. There is a perfect M shape for the 40-day cycle, and if we display the FLD here, the 20-day FLD, you will see a fairly textbook sequence of interactions with price crossing above the 20-day FLD, so bullish that it couldn't even come down to the 20-day FLD for the B category interaction. Nice clean cross down below it, clean cross up above it again, and then a good cross down and a perfect G category interaction over there. I went through the sequence in a previous market update video, so I'm not going to go through it all again here. But what has happened since then is again, not quite textbook, but it's been pretty clean and good. We have had the 80-day cycle trough over there. Here is our first cross where price crossed up above the 20-day FLD. We would normally expect that target to be reached before price comes down and finds support at the level of the 20-day FLD. It didn't, but it has now, I believe, been reached, or perhaps not quite. I think that target is a level of 72.56, if memory serves me correctly, and it hasn't quite reached up to that point. But the time at which the 80-day cycle trough probably formed in the US markets turns out to have been a 20-day cycle trough, according to this analysis, in the FTSE-100. You can see price came down to the level of the 20-day FLD. It didn't quite find support at the level of the FLD. You can see it dropped fairly well below the level of the 20-day FLD, but it did spend every single bar of this period of time with the high above the 20-day FLD and the low below the 20-day FLD, indicating what I describe as approximate support. And so in the FTSE-100, we are expecting price to come down into this 40-day cycle trough, and then of course it will bounce up again, and then we are expecting price to come down into the 20-week cycle trough. So the important lesson here is that stock markets around the world form troughs of the same magnitude very often at the same time. However, when you're looking at a trough of 80-day magnitude, you will sometimes see a little bit of discrepancy from one stock market to another, which is exactly what has happened, in my opinion, recently in the markets, because the S&P 500, the other US markets as well, have formed an 80-day cycle trough over here in early October, whereas the FTSE-100 formed that 80-day cycle trough at the end of September. And there are some markets, I believe, that have recently formed an 18-month cycle trough and not the 80-day cycle trough. The important lesson to take away, I hope, from this video is that even when you are not certain about the exact magnitude of a particular cycle trough, if you have confidence that that cycle trough is a trough of at least 80 days or whatever magnitude trough you are looking to base your trades upon, then having identified that that trough has formed, you can start making sensible trading decisions on the basis of your expectation of the cycle shape that will unfold. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video.